Good evening, everyone. Thank you for joining this evening Corporate Connect featuring Sasseur REIT as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Geoff Howie, Market Strategist from SGX, on recent market highlights, followed by the corporate presentation by Ms. Cecilia Tan, Chief Executive Officer, and Mr. Xie Jianfeng, Chief Financial Officer, and also Mr. Chen Xian Yuan, Head of Asset Management. We will end off with a Q&A session. Sasseur REIT is the first retail outlet mall REIT listed in Asia and strategically located in the fast-growing cities in China, in Chongqing, Kunming, and Hefei. Without further ado, can I now invite Mr. Geoff Howie to present, please? Over to you, Geoff.
Thanks very much, Eileen. Just give me a moment while I share my screen. Okay, ready to go. Thanks very much for the invite. Really looking forward to tonight's presentation by Sasseur REIT. Just a kind reminder, everything we share is educational and should not be taken as advisory. Okay, to move right along, the Straits Times Index, or the STI, it does remain among the most diversified stock market benchmarks in terms of international exposure, and it has more than 40% of its revenue associated with the index actually reported to Asia Pacific economies outside of Singapore. And this is one key reason why the STI has been among the most defensive developed market indices in the year to date. While the STI has generated a 2% year-to-date total return through to the close today, the technology-led S&P 500 index has generated a decline of 18% in SGD terms in total return in the year to date. The technology sector has been the most adversely impacted by the two particular drivers of inflation, that is higher energy costs and supply chain constraints, which has been further impacted by, I guess, the impact that this inflation has had on higher interest rates and potentially lower consumer-driven growth. So the STI is most correlated to the FTSE ASEAN index, or share index, I should say, and the regional exposure is a key part of the STI, okay? So, for instance, in the year to date, the strongest STI stock has been Jardine Cycle & Carriage, the investment holding of the Jardine Matheson Group that is in Southeast Asia. Last week, Indonesia's Consumer Confidence Index for May was reported to strike an all-time high, up near 130, up from 113 in April, and well above the 77 low seen in August 2021. Now, since Indonesia's consumer confidence for August 2021 was reported to plunge down to that 77 level, when it was reported on the 8th of September, the share price of Jardine Cycle & Carriage has rallied 60%, that's 60%, from around $19.30 to around $30.90 at the moment. Dividends have boosted that total return to 65%. So the consumer discretionary play, it reported 92% of its 2021 revenue to Astra and Indonesia. Astra's car sales were dominated by Toyota and Daihatsu sales back in 2021, which obviously benefit from temporary luxury sales tax exemptions, which have been gradually phased out this year. So the banks obviously make a big part of the STI, and the trio of DBS, OCBC, and UOB have averaged 1% decline in total returns so far this year. Asia Pacific banks, by comparison, have declined 5%, and the global banks have declined 10%. Now, aside from higher net interest income in the first quarter of this year compared to the last quarter of last year, the banks did see a bigger quarter-on-quarter increase in non-interest income for the first quarter of this year. The combined net interest income for the three banks in the first quarter was $5.38 billion, which is up from $5.31 billion in the fourth quarter of last year, while the combined non-interest income amounted to $3.37 billion, which was up from $2.97 billion in the fourth quarter of last year. That was on the back of ongoing growth in wealth management services and digitalization. So since the end of 2019, you've got APAC banks up 3% in general, Global banks up 1.5%, while the trio have averaged 19% total returns since the end of 2019, outperforming their regional and global peers. So that's a big part of the STI. Looking at what sectors and stocks have been really moving. As we said, technology has been the worst performing sector across the world, but in the year to date, energy and agricultural stocks have really led the global stock market. Supply constraints from the Ukraine crisis, they had exacerbated those commodity related price gains, which had previously been buoyed by demand factors back in 2021. So among Singapore's most actively traded 100 stocks this year, we've got Rex International, Geo Energy Resources, RH Petrogas, Golden Energy and Resources, with the 4 stocks in the energy sector averaging 56% gains in the year to date. That followed 200% average total returns last year on the pickup in demand, and that 56 on the supply squeezes so far this year. Brent crude oil, it's currently hovering at the top of its 3-month trading range at around $123 a barrel. That's about 60% above its end of 2021 levels, while June Indonesia thermal coal futures are trading at around 65% higher than their end of 2021 levels. The EIA weekly petroleum stats will be closely watched tomorrow night, with the petroleum report last week highlighting that crude inventories at Cushing, which is the largest storage hub in the US, I think they fell 1.6 million barrels for the week ending the 3rd of June, which according to Bloomberg takes Cushing supplies back to March levels, while the gasoline inventories are at their lowest seasonal level in 8 years. So a big key number coming out tomorrow night ahead of the Fed decision as well. But also, I should note that on the agricultural side, as I said, energy has been the best performing sector. Agriculture has been one of the best performing industries in the year to date. Crude palm oil producers have really outpaced the region as well in the year to date. Golden Agri Resources, First Resources, and Bumi-Tama Agri, which also rank among our 100 most traded stocks, they've averaged 33% total returns this year, following 31% average total returns last year. So July CPO futures, they're trading at around 35 to 40% above their end of 2021 levels. And you might recall last year, Golden Agri Resources revenue for the full year, I think crossed $10 billion level, which was an all-time high and obviously corresponded to the stronger CPO prices on the pickup of demand last year. And then again, we've had the supply impacted by the reduction in the sunflower oil from the eastern part of Ukraine this year. So global energy and agricultural stocks really have led the global stock market, in addition to our stock market. But the utility sector, I should also mention, has also been comparatively defensive. Basically, the energy sector has gained, but the utility sector has seen the least declines globally in the year to date. In Singapore, the 5 most traded stocks associated with the utility sector, they've averaged a 4% total return in the year so far. That's mixed returns ranging from a 15% decline for Union Gas Holdings to a 42% total return for Sembcorp Industries. China Everbright Water and SIAS Environment also make up the 5 most traded utility stocks here. China Everbright Water, it's an environmental protection company focusing on water environment management that invests in and operates water protection treatments with a designed daily water treatment capacity of over 7 million cubic meters. SIIC Environment is also a leading water treatment and environmental protection company in China. Now, in 2021, Singapore accounted for 62% of Sembcorp Industries revenue, 35% of Keppel Infrastructure Trust's revenue, and 100% of Union Gas's holdings revenue. So together, that trio of the Singapore-focused utility plays, Sembcorp Industries, Keppel Infrastructure Trust, and Union, have averaged a 1% gain so far in this current quarter to date, while the STI has actually declined 7%. And after outpacing Sembcorp Industries and Keppel Infrastructure Trust in 2020 and 2021, Union Gas Holdings has actually declined 15% this year, as the escalating energy prices can lead to rising operational costs for the group. However, the group did reiterate in April, it can implement measures if necessary to cushion against the impact of higher fuel prices, which may include raising the prices of its energy products. So moving right along to my last slide before the next presentation, and just to focus on REITs, okay? So for the past 20 years, actually coming up to 20 years, July 17 will mark 20 years since Capital More Trust actually listed with its 3 properties. So it's coming up to very close to 20 years, but since then, Singapore has grown to be one of Asia's largest REIT and property trust markets. As of the end of May, the combined market value of the REIT sector, it stood at 111 billion Sing dollars, and that represents around 12% of the combined value of all stocks listed for trading on the Singapore Stock Exchange. And the sector also contributed 20 to 25% of the combined day-to-day turnover of all Singapore stocks. Now, the trusts, they are highly diversified across property types with a nice balance across retail, industrial, office, hospitality, in addition to multiple REITs investing in healthcare-related properties and specialised REITs such as data centres. Now, as many as 18 of the trusts exclusively invest in property assets outside of Singapore. 19 of them invest in properties in both Singapore and outside of Singapore, and the remaining 4 REITs invest purely in Singapore. And this includes, in terms of this international reach, as many as 10 trusts with properties in China, 8 REITs with properties in Japan, 6 REITs with properties in Malaysia. There are a handful, that is 5 S-REITs and property trusts with pure exposure to China property assets. So Sasseur REIT, BHG Retail REIT, and Dasson Retail Trust, which is a property trust, are retail REITs. While EC World REIT is an industrial REIT and CapitaLand China Trust is a diversified REIT. Of those 5, you've got Dasson Retail Trust as the actual property trust, and while the others are REITs. And I guess despite this backdrop of increasing rates, particularly important this week, as we've seen just over the last 2 sessions, majority expectations go from a expectation of a 50 basis rate hike this week by the Fed to a 75 basis hike by the Fed. We've got this backdrop of increasing rates, but nonetheless, the REIT sector does maintain an average dividend yield of 6.4%. And that still offers a high yield spread of around 300 basis points to the Singapore government 10-year bonds. Furthermore, the sector appears to have controlled debt levels with an average gearing ratio, as you can see, total average is at 36.9%, lower than the regulatory limit of 50%. And as we've noted before, the sector has on average secured 75% of their borrowings on fixed rates. Now, data centers and industrial REITs, they really outpaced in 2020 into 2021 as well, as did manufacturing stocks and those sectors that were least negatively impacted by the COVID-19 constraints. But as shown in this table, those 2 sectors have not been the outperformers. In fact, they've been the underperformers this year. And it's actually the hospitality staple trusts that have been the strongest segment of the REIT sector in the 2022 year to date. The reopening momentum has supported a brighter outlook for the RevPAR, which is the industry term for revenue per available room, and the 4 staple trusts in particular. That's for the 4 staple trusts with Singapore properties. So with a 43% total return in the year to date, you have Frasers Hospitality Trust has been the best performing APAC listed REIT across APAC for the past 23 weeks. Yesterday, a wholly owned subsidiary of Frasers Property has proposed to privatise Frasers Hospitality Trust through a trust scheme of arrangement. And I think the consideration is at 70 cents per share, or 70 cents per unit, I should say. Now, Far East Hospitality Trust, Ascot Residence Trust, and CDL Hospitality Trusts, in addition to the diversified REIT Suntec REIT, have also ranked among Asia Pacific's strongest performing 20 REITs so far in the year to date. CapitaLand Integrated Commercial Trust has also, for much of the year, been very close to ranking in the top 20. And then Mapletree North Asia Trust was also among the top 20, which had its last trading day on 8th of June with the merger with Mapletree Commercial Trust, bringing the total number of REITs and property trusts listed for trading on SGX down to 40. Now, CapitaLand Integrated Commercial Trust, it does constitute an 11% heavyweight in the IHS REIT index. So its 6% total return so far this year has had a significant impact on the IHS REIT's indices comparative defensive decline in total return of just 2% in the year to date. Now that, I might also add, Sasseur REIT has also generated a decline in total return of 2% in the year to date, which has been very defensive when you consider at the same time the FTSE EPRA Nareit Global REITs total return index, of which we in Singapore account for around 3% of this big global REIT benchmark. That index has actually declined 20% so far in the year to date. So that's been a pretty big turnaround in terms of performance with the comparative performances of the second half last year, which saw a 1.6% total return for the IHS REIT index, while that FTSE EPRA Nareit Global Index basically gained 12%. So we've seen those longer term returns of Singapore and the global benchmark converge with a little bit of more outperformance of Singapore when you look over the last 12 months or so. So I should move right along. Sasseur REIT, it listed more recently than CapitaLand More Trust obviously did back in 2002. Sasseur REIT listed in March 2018. And since it has listed, it has outpaced both the IHS REIT index and the FTSE EPRA Nareit Global REITs index. And it also operates this very popular outlet mall depicted in the photo here. So I think now might be a really good time to pass over to Cecilia, Jianfeng, and the Sasseur team. Thank you so much, Eileen.
For the update on the S-REIT. Up next, may I just invite the senior management from Sasseur REIT, please. Over to you, Cecilia.
Thank you. First of all, thank you, SIAS, for this opportunity for all of us here at Sasseur REIT to be able to profile Sasseur REIT, and also thank you, Geoff, for that shout out to Sasseur REIT in terms of our resilient performance. Yeah, thank you all for tonight. I think before we start our corporate presentation, we always feel that a picture tells 1,000 words. So we have prepared a short video to showcase really the vibrancy that you can see in our outlets. And over to my colleague to play the video.
生活有浪漫的情怀，时尚有理性的思考。沙之船重庆两江澳来，真向美好生活探索无限可能。风格化的商业街区，沉浸式的消费体验，全新多元场景，点亮城市坐标。在这里，我们与艺术商业温暖相融。引入前沿时尚 IP， 打造超强品牌矩阵，汇聚全球名品折扣。四季更迭，假日佳节，精致生活，轻松 get。在这里，我们与世界风尚零距离。打通线上线下会员生态体系，积分卡券随时可查，丰厚福利花式来袭，尊享 VIP 邀您解锁更多玩法。在这里，我们与每位顾客心连心。如今很多人会选择逛街购物去奥莱，休闲娱乐去奥莱，沙之船重庆两江奥莱，用心构筑一座城市的多元社交场，将一切清零，从头开始。探索奥莱本质，重新定义年轻与时尚的生活方式。奥莱，真享美好生活。
Thank you. I hope he has boosted your evening tonight with this, vibrant video. I think before we start the presentation, I'd like to introduce the panelists with me from my team here. Joining me is my CFO, Xie Jianfeng.
Afternoon.
And also our head of asset management, Chen Xingyuan.
Hi, everyone.
Okay. So yeah. Thanks. I think you might see in the video, the video is actually the same picture that Geoff used on his presentation on page 5 earlier. All right, that's actually our flagship shop in Chongqing, Liangjiang. Okay, so Chusi, let's go down with the presentation now. I think we'll start off by giving everyone, I know some of you here are already existing unit holders of Sasseur REIT, and thank you very much for investing in Sasseur REIT. I think for the benefit of the others, I'd like to do a quick introduction about our sponsor Sasseur Group and also about the key highlights of Sasseur REIT. Yeah, I think interestingly, I think many people think of outlets industry, but to us, outlet in China is a very unique and a very niche market. In fact, we see this as a sunrise industry. It is one of the fastest growing outlet sector in China. And in fact, it is poised to become the world's largest by 2030, based on the research by China Insights Consultancy. And of course, in terms of our industry, our target consumer base is a growing middle class population with huge spending power, as we can see the rising spending power, and we have great exposure to the high growth tier 2 PRC cities. Now, in relation to Sasseur REIT, we have to talk about Sasseur Group, because that's really, their core expertise in running the outlet malls, and they are the leading privately owned outlet operators in China. And over the 30 years, they have been, including, my chairman who started this business, they have gained deep understanding of the local retail market and also have developed diverse brand relationships, which is really, the core capabilities that they bring to the outlet. And of course, later we'll share with you the unique art commerce business model with the super outlet concept. Yeah, so you would remember Geoff mentioned that we are still a relatively young REIT. We got listed in March 2018, and this is some of the pictures. In fact, this REIT is actually an initiative by the China-Singapore Chongqing demonstration initiative on strategic connectivity. So really, we are a sort of showcase project of this relationship between China and Singapore trade platform. Moving on. Okay, just very quickly in relation to Sasseur Group, you see the gentleman in the picture, that's our founder and chairman of Sasseur Group, as well as the chairman of the REIT manager here. So the group actually founded in 1989, so it's more than 30 years in business. And clearly right now, over the years, right now the group managing 14 outlets, including 4 owned by Sasseur REIT in 13 major Chinese cities. I want to mention that actually in 2008, the outlet business actually born out of Sasseur Group when my chairman brought his retail expertise into the outlet business, and that's how the outlet of business in Sasseur Group started in 2008. Moving on. Now, I would like to say that our sponsor, definitely one of those things that they pursue, they are relentless in the pursuit of their retail outlet operations. They have won many industry awards, so you can just see some of the listings here. And I would also like to highlight in relation to the revenue potential, or the actual revenue that have sort of gained by these outlets over, say, in 2021, you can see in renminbi 2 billion, right? In Singapore dollar terms, you're looking at about more than 400 million. So that's really a very strong revenue capacity. And Chongqing and Liangjiang is the #1 in the league table for the Sasseur Group. Again, this is actually the core sheet, the flagship outlet in our portfolio. And in relation to also those sort of like the ROFO assets, you have the Xi'an and the Guiyang also ranked very high. And later I can share a little bit, give more color about these ROFO assets. Moving on. Yeah, so interestingly, I think we have a formula that sort of characterize what we talk about our super outlet business models: A times 1 plus N times DT. So just unpack this. Really, A is actually what we talk about the art. I think one of those things you will notice is that every outlet that we have, structurally, they are very different, because there's this artistic element that we want to incorporate into really the hard aspects, the brick and mortar aspects of our outlet, so that it will sort of differentiate and have a sense of presence. And times one is actually the basic outlet operations, but N, this is the I would say this is differentiating factor, because this is the part that we know we look at. If you look at this slide, you will talk about super children's center, super sports hall, super farm. So this is the super concept that we bring that will sort of expand the outlet beyond the traditional concept and model. And times DT is data technology, and we are very big in terms of mining all the data relating to the consumption and the sales spending of our consumers, particularly VIP, and that will continue to shape our trade mix and also the positioning of the outlet for it to continue to remain competitive. Yeah, moving on. Okay, I should just quickly talk about this EMA model. I feel that this is really our key differentiator. Now, at the sort of the left-hand side, my left-hand side, you'll see our business model. Now, in our outlets here, we are quite different in relation to our underlying leases. Traditionally, a lot of retail landlords, they would have a base rent structure or fixed rent structure. In our outlet business, because of the nature of us wanting to stay very agile, most of our leases are actually turnover rent only. So meaning to say, some tenants don't even pay base rent. And then, so how do we make money out of this? We actually have a commission structure in terms of our leases, where it could range between 10 to 16%. So you can think of it as GTO, which is gross turnover rent. And so this model truly aligns 100% of the landlord's interest with that of the tenants, so that the tenants' fortunes are combined with the landlords, and also the landlord is motivated to really bring about the success for the tenants. But clearly, because of this underlying leases, which are 100% turnover, we feel that it was not very appropriate for them to sort of be REIT friendly. So what happened at the time of IPO, we actually conceived this, which is the entrusted management agreement model, and you called it EMA resultant rent. So what we have done is that this is structured in order to provide stable returns and cash flows to unit holders, which is more in line with a REIT mandate. So you can see that our rent is built up of two components, a fixed component and a variable component. Now, the fixed component is actually already started at IPO, and it will grow at 3% every year. So in a way, it's designed to provide some level of visibility and stability, and also with a sort of visible 3% growth to unit holders. And this component has been historically, since IPO, contributed about 70% of the overall income to the REIT. And the balance 30%, which is represented by the variable component, as you can see, is actually a percentage of the overall sales of the 4 outlets, and it will range from 4 to 5.5%, and this is a blended rate. So, and this together will deliver the total DPU to our unit holders every quarter. Okay, moving on. So, yeah, just to give you a quick highlights, we have just reported our first quarter results in May again, and I'm very pleased that we have once again broken our own record. This is our record first Q DPU for since listing. So in relation to some of the highlights, distributable income of 24.7 million for the first Q is 4.7% higher year on year, and what that translated to a DPU of 1.822 cents, which is still 3.6% higher, despite the fact that we have actually retained 10% of the income in first Q 2022. In relation to outlet sales, yes, I think it didn't do as well as year on year compared to 2021, and later we'll explain to you some of the unique factors. Is down by 3.6%, and sort of like overall rental income is still positive of up 4.6% relative to 2021, and that is really a function of the EMA model that I've just described, that giving you some level of support through the fixed income component. Now, in relation to sort of the balance sheet and also the portfolio matrix, I will leave it more the details to my colleagues, but I will say just a couple of things is that you can see our average is very low. Geoff Howie mentioned earlier that industry average is about 37%. So clearly, we are very low. So in relation to the financial risk, we are very prudent. And that the flip side is also that we have a lot of debt headroom to pursue acquisitions that will make the sort of the acquisition more lucrative. And in relation to our portfolio occupancy, clearly, I think some of the AEI we have taken in the last 18 months have sort of proven results, and that have also given rise to a higher portfolio occupancy of 95.4%. So going to the next page, yes, as I mentioned, this time around, again, our highest first quarter DPU since listing. And a couple of things I want to just highlight on this page is that in relation to, you can see our DPU profile has been growing year on year despite the COVID environment and the severe COVID environment in China since 2020. And in fact, the total return since IPO, for some of the investors here who have been very loyal with us since IPO, you would have gained about 38% thereabout. So I think it's very respectable returns we have delivered despite the challenging market environment. And we are also one of the few REITs that still maintain quarterly distribution. So investors will continue to be able to enjoy a more regular income stream on a quarterly basis. So with this, I'm going to hand over the time to my CFO for the financial highlights.
Thanks, Cecilia. Now let's see some financial highlights for Q1 2022. So in this quarter, our 4OLED sales dropped by 3.6% year-on-year to renminbi 1.1 billion as a result of a weaker buying sentiments after a new wave of COVID-19 outbreaks, which affected shopper traffic, particularly in March 2022. Having said that, there have been no outbreaks in Chongqing, Kunming and Hefei, where our 4OLEDs are located. Our EMA rental income in renminbi rose by 0.7% year-on-year, cushioned by higher fixed component of EMA rental income of renminbi 109 million. The EMA rental income in Singapore dollar of 34 million was 4.7% year-on-year, higher in line with renminbi appreciation against Singapore dollars by 4%. Sasseur REIT has achieved a record high Q1 distributable income in 2022 of 25 million, up 4.7%. DPU before retention was 2.024 cents. So even after a cash retention of 2.5 million or 10%, DPU still hit 1.82 cents, 3.6% higher than Q1 2021. Moving on. So from this page, we could see a robust and healthy balance sheet. Our properties value was higher by 0.6% at 31st March 2022, contributed by renminbi appreciation against Singapore dollars and capitalization of capital expenditure of 1.9 million undertaken in Q1 2022. So as a result, NAV per unit has seen a marginal increase at 99.22 cents. Okay, next page. And now let's have a look at our capital management. This page shows our well-balanced debt profile, which consists of China onshore and offshore loans. The onshore loans occupy 54% of the total loan profile, and the offshore portion took out another 46%. The maturity date for both onshore and offshore loans were March 2023. Currently, the manager is in active discussion with various lenders to refinance the loan and aims to de-risk the current debt profile by staggering debt maturity and amount. The REIT manager targets to complete the refinancing exercise by end of 2022, ahead of the March 2023 maturity. So moving on. So this page shows our prudent capital management situation. The key highlight is still the lowest gearing among OS rate at 26.2%. This allows us ample debt headroom to support future growth. And to confront the current rising interest rate environment, the borrowings hedged to fixed rate and with stable interest rate amounted to 72% of the total, which includes 40% of the offshore loans and all the renminbi denominated onshore loans. Next page. This page shows the trend for China 5-year LPR. You could see from the chart that it is quite stable at 4.65% per annum for quite a long time. And in 2022, the 5-year LPR was lowered by 20 basis points, and it's actually the largest cut in the recent years. And it shows China's government's determination to boost the economy under current pandemic situation. as LPR is observed to be stable with a downward trend. The hedging on renminbi loans is not necessary, and we have 54% profile in China, so this will benefit Sasseur REIT. So here I end my session. I hand over to my colleague Xing Yuan to continue the next part.
Okay, thank you, Jian Feng. Thanks everyone for attending. Next page. This page shows the portfolio summary. You will see that our total valuation renminbi is $8.5 billion, equivalent to Sing dollar 1.8 billion. So looking at the table, from 2019, it was 8.2 B, and then dropped to 8.1 B in 2020. However, there was a rebound by about 4% to close to 8.5 billion in 2021. This shows the strong fundamentals of our operations. Next page. This page shows our 1Q 2022 outlet sales summary. You will hear from our CFO that there is a drop on a year-on-year basis and versus last year same period. The reason is because due to the outbreak of COVID-19 in China, which most of you have read in the news in March. Actually, our sales in January and February was actually doing better than last year. However, as you know, due to China's zero COVID policy, this has actually affected our shoppers flow and thus indirectly affecting our sales. Then in terms of sale, Kunming, the drop is more at 19.5% because Kunming, being a tourist city, has seen a drop in tourist arrival. And then of course, there was some inventory impact due to supply chain disruption. Next page. This one shows our well-diversified trade mix. The bulk of our trade mix are actually in fashion, international brands, and sports. By NLA is about 61%. By revenue is about 80.1%. Next. This one shows our strong occupancy. We have hit by 1Q 2022, 95.4%. Just an inch lower than what we have achieved pre-COVID of 96%. A special highlight would be our occupancy in Bishan. In 3Q 2021, it was at a low of 80.6%. Due to our AEI efforts to reposition the mall, it has improved from 80.6% to close to 86%. Next. This one shows our weighted lease expiry. So by gross revenue is 1.3 years, by net lettable area is 2.6 years. You will see that our weighted average lease expiry is lower than the conventional malls in Singapore and other REITs is basically because we go for shorter leases because we are going for tenants or brand champions. That means because only those that perform, we will retain them. Those that are not performing, we will try to replace them with new brands and new trends in line with the market. So you will see that in 2022, our WALE by revenue is 52.7%. This is an 11% drop from our last Q of 63.6%. Next page. This one shows our VIP members. From 2017 at 793,000, it has increased to close to 2.7 million, a CAGR of 45%. Next page. This one is our Bishan outlet. So you will see the before and after pictures. So we have converted a driveway into a pedestrian mall, connecting a certain zone to the main building. And we have also converted Zone A into a sports theme park. These are some of the pictures showing the housing of Fila, Nike, and some popular domestic brands. Next. These are some of the activities that we have in 1Q. Next page. So these are some of riding on the latest trend to engage shoppers. On your far right, you will see the Hefei outlet, the live streaming. We have at least 10 live streaming per quarter. Next slide. So the next slide, I will give you a short overview of the market review in China. Next one. Okay, this one shows the GDP growth, the retail sale growth, and the disposable income. in 1Q, you will see that actually it's all positive. So we are waiting for the 2Q numbers, which will announce in after the 2Q results are out. So in terms of the latest figure in April 2022, the total retail sales of consumer goods was around RMB 2.9 billion. This is a decrease of a year-on-year of 11.1%. The reason being is that due to the lockdowns in Shanghai and in some major cities. Next slide. This one shows the challenging times ahead. As we have actually said, the weaker buyer sentiments due to the outbreak has resulted in a lower sales in April and May. But as of 13 June, there were only 84 symptomatic new cases reported across in various cities in China. Both Beijing and Shanghai has eased widespread COVID curves. And then the lockdowns are actually targeted in both cities. So we actually see a downtrend, and you will read in the news that the curves has actually eased over the past 2 weeks. Okay, thanks. Over to you, Cecilia.
Thank you, Xing Yuan. Okay, we're coming to the end of the presentation. I would like to sort of share with everyone our near-term management focus and priorities. Next page. So we adopt a multi-pronged strategy. Clearly, as you have heard from my colleagues, I think in relation to asset management, that's really key for us. That's really, making sure that particularly in current COVID environment, we maintain really stability and resilience to our operations. So we'll be undertaking very targeted asset management strategy, and with a focus of trying to maintain our portfolio occupancy above 95% as far as we can. And also continue to sharpen the appeal of outlets to take advantage of the current policies by the government to boost domestic consumption. Clearly, as my CFO has also mentioned, a key corporate objective for us this year is really to complete the refinancing ahead of the debt maturity. The debt actually won't mature until March 2023. But we have actually already started the process since last year in preparing for the refinancing. So I think as far as we're concerned, we are quite optimistic that it should get completed by this year. In relation to the growth plans, clearly I think acquisition will be a very important milestone for the REIT to expand its portfolio. And at this moment, we are closely looking at actually the ROFO assets owned by the sponsor. And the next page, I will share with you some color on the 2 ROFO assets owned by the sponsor. This is actually a very large asset as well, owned by the sponsor in Xi'an. Interestingly, you can see in terms of the GFA is close to about 1.4 million square feet. So this is really around the size of a Vivo City, I think. And this is a very good asset because it's directly connected to the Metro Line 3. And it is one of the largest outlet malls in the Northwest region, and we have something like 400 brands. So this asset started operating in 2017. So we believe this asset has really sort of stabilized, and we are sort of looking with a great level of interest to see when we would be in a position to activate the acquisition of this asset. Going down, Guiyang is also another ROFO asset that's available for the REIT to acquire. In relation to Guiyang, in fact, in terms of size, is even bigger than Xi'an. But really, in terms of the Xi'an and Guiyang, in terms of the local domestic dynamics, you can see Xi'an, the population is bigger, and also because it's a more internal tourist location. So Guiyang definitely presents an appeal, but between the two, we feel we are a little bit more, inclined to look at Xi'an as a matter of priority if, let's say, we were to have the opportunity to acquire a ROFO asset. Moving on. I will also mention that what has happened is our sponsor has only these 2 ROFO assets on its balance sheet, and over the years, it has taken on a different strategic path in its business operations. It has gone asset light. When I say asset light, meaning to say if sort of be taking over taking master lease over third-party assets, a long master lease of it could be between 10 to 20 years, and then sort of wrapping around those assets as a Sasseur Group managed outlet. So they have done this, particularly they have ramped up their operations since 2017. So right now they have from Hangzhou to Suzhou. Suzhou was last opened in 2021. And next page, you will see how because of this strategy, the time to market has reduced so much, and also the risk for them, without a development model. They now have plans to sort of open 6 malls from this year until 2024. And in fact, they are going to inch towards the tier 1 cities. Right now, they are concentrated more in tier 2, tier 3 cities. And with this, I think they will continue to expand their footprint as well as branding across China. I feel this will actually continue to provide that future growth opportunity for Sasseur REIT, because this sort of pipeline assets, as we call them, no doubt they owned by third-party sort of property owners. They could also be made available to Sasseur REIT to acquire when the opportunity arises. So with this, I'll do a time check, 7:45. So we will be happy to answer any questions for the remaining period.
Cecilia and the City Management for Sasseur REIT. We have now come to the Q&A session. May I invite Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the Q&A session. Participant, you may input your questions in the Q&A session, and our Facebook audience, please click on the link in the description box to join. We will try to answer as many questions as possible. Over to you, Benjamin.
Thank you very much, Cecilia, Jian Fang, as well as Xing Yuan for joining us. Not every day that we get opportunity to speak to a REIT that has got a very unique value proposition, where all your assets portfolio is in one country, but of course it's a huge country with hundreds of millions of people in the middle class. So great opportunity for our members of the public and our members, SIAS members, to ask you questions. Now, as you can see, we already have got quite a few pre-submitted questions. We're going to start with the elephant in the room, just to get it out of the way. So 100% of your portfolio is in China, and you've given us quite a fair bit of color regarding the situation in China. So quite a lot of the questions that we have are predominantly related to the COVID-19 pandemic, how it's being handled. And of course, over the weekend, the last weekend, the one that passed, there was a new cluster, I believe, was it a bar or something, some dining outlet. And it appears that, these 2 cities, Beijing as well as Shanghai, may be contemplating new COVID measures. So it appears that China seems to have this rolling lockdowns, right? Just like what Singapore had in the beginning. Now, so the question here is, how does this affect the business strategy of Sasseur REIT, its financing, and as well as its distribution per unit to shareholders back in Singapore?
Thanks, Ben. Yeah, I think maybe let's address the elephant in the room, like you said. Let's really address the COVID impact, because I think clearly that must be the #1 concern on the minds of my unit holders. I think let's sort of like, if you go back in time, actually this COVID situation started really in Wuhan, right, in 2020, and that that time was really very severe for China and for the world, and we don't even know what we're dealing with. It was so severe that we had to shut down all our outlets for about 7 weeks, in the first half of 2020, because just a huge public crisis, and there was also the determination to maintain the health and safety of the employees and consumers. But if you look at the historical data, despite the fact that we closed our outlets for 7 weeks, thereabouts, for even including, we actually delivered outperformance of DPU in 2020, even better than 2019. Now, if you recall, 2020, in fact, in Singapore, it was also very severe, and many REITs actually had to cut DPU, particularly the retail REITs, in order to provide financial support to their tenants. But why is it that even in 2020, in so severe, we could still deliver an outperformance in DPU? I think it has to do with the fact that, #1, there's actually a lot of consumer power in China. And what we actually saw was a fast and furious V-shaped recovery, because people are clearly locked down for fairly long period of time. And then when the malls reopened, we actually had exploded DPU in 3rd quarter and 4th quarter of 2020, that helped us deliver the overall DPU outperformance. Right now, the pandemic didn't really go away. So 2020, later half of 2020 was actually a better year for China, because it enjoyed good economic growth. But 2020 for the rest of the world was really quite bad. But the situation somehow has changed in 2021 and 2022 as well. 2021, I think China, you recall, still continue to experience sporadic COVID outbreaks here and there, but generally they are quite well contained. And so we also delivered outperformance DPU in 2021 of 7.104 cents. I think the 2022 COVID outbreak, perhaps the Omicron virus is something that is so infectious that, you know, they are, because China's insistence with the dynamic zero policy, I think they are fighting fire all the time. But I want to highlight a couple of things is that, first thing, none of our outlets are in the sort of severe COVID areas of Shanghai and Beijing. We are very far away. But having said that, you can see even for our results, as we mentioned, our first quarter results, our March numbers came in way below what we had hoped for. And we were actually already not surprised, because what has happened is that even though you have lockdown in Shanghai and Beijing, generally the other parts of China also suffer from a fear of virus spreading. And so there were government controls about people movement. So that also affected buying sentiments as well. And we have also guided the market that our April and sales were indeed also quite weak. But interestingly, you know, with the reopening of Shanghai, we have just gotten some feedback from our operations on the ground. Things are hoping to be normalized, but not fully yet. But at least the supply chain problem that we saw because of the Shanghai lockdown is easing up now. That's very important for outlets, because outlets, one of those things is that we really need to have the inventory in our stores for our tenants to be able to do, you know, to do the sales and also to entice shoppers back to our malls. But as part of the whole strategy, right, we have accelerated, as you can see from the earlier presentation, we have accelerated this whole digital platform as well. In fact, we have now created what we call Ye Ao Lai. So it's like a night market. Okay, so this is again our response strategy. Okay, I don't think this is a reactive strategy, but I think this is also a considered strategy, because part of that, we also notice the millennials like to shop at night. Okay, so we are trying to capture really all the different segments of the consumer market, but this we see is also continue to complement and supplement our sort of like brick and mortar sales. When things become challenging for shoppers to come, we will do that. So I would also like to share that, you know, one of those things that operationally we are thinking out of the box all the time. You know, we even have a program to call our, you know, top spenders for them to come to the shop to spend during this period. And if they're not able to come, we send the online shop to them. What do you mean by that? We actually send them a QR code, and then they can start shopping online. So, you know, we are really sort of gravitating and sort of multi-pronged strategy in order to make sure that, you know, whether this COVID is here or not going away, we are going to try to reduce the volatility to our sales. So, of course, you know, I've often been asked about, okay, what do you think of the China strategy and, you know, my outlook for the economy? I think clearly my guess is as good as your guess, but I think generally speaking, I think this COVID approach taken by China is, my greatest fear is the prolong of it, because the longer they drag out, it affects buying sentiments, not because we have unwilling shoppers, but because people generally then, you know, they have people movement restriction. You can see how our outlets in Kunming was very, very hard hit, particularly in first quarter, because Kunming was actually, their location was actually near to the border of two cities. So with the controls, it does deter some people coming to our malls. But I would say, generally speaking, we feel the domestic market is still very strong. You know, and we are generally upbeat and optimistic when things start to normalize in second half. We will have the opportunity to hopefully recover the lost grounds in first half, because we have retail seasonality in our business. In our second half, we tend to have better sales because of a few unique factors. Number one, we run our annual September anniversary sales in September. So, and you know, those will be the bombastic sales that we want to chalk up. And also in second half, we tend to sell winter clothes, which tend, you know, apparels. So items which are cost more, So per ticket item, it will be higher. So we hope that the second half will be better for us to, to really rally up the sales that was lost in the first half. Now, in terms of how it's coping with inflation, and okay, I need to address the inflation issue. Now, I would like to highlight in our EMA model, right? All the operating expenses, the property operating expenses were all absorbed by the sponsor. So in a way, the REIT is totally insulated from any inflationary pressures relating to operating costs. Now, because of this, right, my sponsor has also begun to look into its own operations. They have also looked to become more nimble and more efficient. So I think in a way, this inflation has also caused my sponsor group to be more productive in relation to how they're going to run the malls because of the fact that they have to absorb operating expenses. So I think on the part of the consumer spending, I have also addressed that. I hope I have generally addressed the bulk of the questions relating to this component.
Thank you very much for that, Cecilia. And I want to bring back the attention to the DPU. So the DPU results for Sasseur REIT the last 2 years has actually been quite respectable given the challenges in China. And my question, this is a new question, is that is this a result of the EME, the fixed component part that provides some stability? And you mentioned that there was a fair bit of revenge shopping. People who came out of the lockdown, they went to went berserk, and that's why your DPU actually improved in Q3 and Q4 since you're on a gross turnover basis. Is that why? Could you provide more color with that?
Yeah, let me give you a bit of color. Definitely, I think the EMA with the fixed component has been very instrumental in providing the stability, because you can imagine if we had a structure like one other hotel REIT, right, is a naked position. When the malls, when our outlets were closed for 7 weeks, then if we adopted that, then it would be zero income to the REIT, and you can imagine the impact in relation to our DPU. So definitely the fixed component is, so it was actually designed from the beginning to mitigate some of the volatility because of the underlying leases, which are generally or mostly turnover rent. So that was actually 2020, but I should highlight, when it comes to 2021, the strength of the DPU was also the result of the early refinancing of the offshore loan that we completed in September 2020. And you can see actually we actually brought down the cost of debt from 4.9% to 4.4%, and the full year effect was felt in 2021, right? So I think it's a combination of our prudent capital management, plus also the unique EMA model that gave some level of support, and also our 3% inherent built-in in the fixed component. So really, I always tell my unit holders, you get the best of both worlds, because when the sales outperform, you get the kicker in the variable component. Though now it's 30%, but you're still able to capture the upside potential. If not, you wouldn't be able to do that in a fixed rent model.
Yeah, certainly that's a very welcome change compared to some of the business models from the regular REITs. So that's great. And personally, I look forward to your night market. I can imagine that I can eat my way through from one side to the other side. Yeah.
I don't think you can eat, but you can buy a lot of things for sure.
Okay, it's the other time. Okay, my wife would love this. All right.
It's an online night market.
Okay. Yeah, she does most of the shopping at night anyway. Okay, so jokes aside, you touch a little bit on the refinancing that Sasseur REIT had completed previously, and also the substantial proportion of your debt load needs to be refinanced next year. Perhaps a little bit more color on how the discussion with that is happening, given the short tenure that's left, as well as the what you call the lending rate that we have in China at 4.45%, was it?
Yeah, okay, I will get my CFO to give the response to this.
Yes, sure. So we all know that there's a concentration risk of our loan profile. So back in 2021, when Cecilia and myself on board, we had studied the refinancing journey and trying to divide the 4 properties into 2 financing portfolios, each with different maturity date, so to address this risk. And currently, refinancing is well underway. and discussions are ongoing with a selected group of China, Hong Kong, and Singapore lenders. It's essentially arranged as a club loan deal, which means 5 to 6 banks will join and split the shares equally. So far, the banks are in the approval process, and we are looking forward to get all clearance in the coming months. So if you ask us, we were quite optimistic about this process, and we target to complete it within the year in 2022. But actually, currently, the most challenging part is the cost saving. Is particularly currently in the rising interest rate environment. So what we have done is that we are trying to split our onshore and offshore portions. Originally, it was 54 onshore and 46 offshore. And now we intend to increase the offshore portion and decrease the onshore portion, because the offshore loans was still cheaper than onshore loans, even after China's recent drop of FPR. So this structure change, we believe will decrease the weighted average cost. So that's what we are doing right now. Yeah.
Thank you very much for that. Certainly adds a lot of color to the refinancing question. And I think that's kind of in the psychic of the retail investors here, because if you recall 10, 12 years ago, the great financial crisis, a lot of the REITs at that point in time in Singapore were stuck with a little bit like bullet loans. So they had to pay a substantial proportion of their loan portfolio at a specific time, and they were basically caught out. So it's great that you guys have got plans and you guys are already in the approval process. So that's one worry ticked off. The other question from the pre-submitted bunch is the FX effects, since the vast majority of the revenue, all the revenue, comes from mainland China. And of course, the DPU is paid out in Singapore dollar. Is there a hedging policy, or how do you manage the FX risk?
I think there are two approaches for that. One is the natural hedging, because we have China onshore loans, which is calculated in renminbi. So that's a kind of a natural hedging for that. And the second approach is we will enter into the foreign currency forward contracts to limit the rate exposure for renminbi-denominated cash flows. So we normally hedge the 50% of our distributable income. So just to reduce the volatility, especially currently, the market is quite challenging. So going forward, we are still do that hedging to make it safe.
Okay, I guess the word challenging is an understatement. The market is going bonkers.
Yeah.
Tonight is going to be exciting as well, I suppose. So thank you very much for that. We're going to move to the questions that came out live as we were speaking just now. The first question is about the online platform, and I think you've already alluded to that. So if you've got your night market, and for the big spenders, you actually do send them the QR code, so on and so forth. Yeah, apart from that, is there a traditional like website where people can go and look at the offerings of all the different shops in your portfolio and to buy stuff?
Yeah, Xingwen, you want to address that in terms of our online strategy?
Sure, of course. Hey, hi, Ben. I'll address this question on the online strategy. So basically, we are actually ramping up our presence in 6 omni-channels in China. So one of it is the WeChat mini apps, which Cecilia can send you the QR code where you can do night shopping. So then, of course, we also have Xiaohongshu, TikTok, and TikTok is is a platform that many of us here will understand. And then, of course, we have the other platforms. So our sponsor or our operational team is actually ramping this up. And then in a case where in Kunming, we even have a banner in one of the cities near Kunming saying that you can shop online 24/7. There will be no closure. So this is some of our online strategy that we are adopting currently, and we are seeing very good results.
I mean, certainly in many ways, China is a very much more digitalized society compared to Singapore.
Yes,
I mean, like
yes,
my
yes.
friends live in China, they don't go out with their wallets, but you just have a handphone and just zap, right? We still go out with our wallets for some reason, right? So certainly that's a, definitely a very beneficial approach to the market that you have. Now moving on to a different question. There's a question here about the tenant leases. Will your short lease with tenants create an uncertain income stream?
Xing, you want to address our short view?
Sure. Okay, so regarding the short wheel, maybe I bring you back to the operational model that we have that Cecilia has mentioned. More than 90% of our leases where our rental actually comes from the sales of 10 to 16%, we collect a commission, which is our rental income from the total sales. So with this in mind, we do not want a long lease. Why is that so? Because every quarter or every half a year, our operational manager will re-look at the trade mix. They will monitor the sales of every brand and every tenant very closely month by month. If they sign a very long lease with us and their sales are not up to target, then we will have a problem terminating or replacing them. But if we have a short lease, says, look at our weighted average expiry by years, by gross revenue is about 1.3 years. We have more flexibility, we have more room. Let's say when we are doing our tenants remix, we are adjusting, hey, you are not hitting our sales target. So therefore, we will terminate the lease and replace you with someone that is actually performing better. Then of course, on top of that is that because the consumer preference taste is changing very quickly in China. Today, I like brand A, but tomorrow I may like brand B. So that's why it offers us the flexibility. So for us, short lease is not an issue because it is in line with our business model. I hope that answered the question.
I would say that the light bulb just went up here. So this is a dramatically different model compared to all other REITs that I'm familiar with. But the impression is that this is kind of like the Lazada or the Amazon, but the brick and mortar model, where you have prominently show products and services that people like, and if they're not making the cut, just throw them out, and then you get.
Actually, there's a word for this, just a short word: cultivating brand champions. That means we look for brands that sells. So only brands that sell, we will cultivate and our resource, and we will keep them in our malls.
And it ties in with your operational model, because then you always have a fresh slate of shops, and it makes going to the shops, the shopping mall, an exciting prospect.
Yeah.
Right? Like if you go down to any Singapore shopping mall, it's the same old. That's why I only go there during Christmas. But it's a bit exciting. Yeah, it's game changer.
Then I think, to adopt this model, the landlord has to be very strong operationally, right? Because you don't have the usual conventional support of a fixed rent income. So you can see that why Sasseur Group is still a leading retail operator, because they really hone these operation capabilities. I can quote you one example. They train the tenant salespeople. Okay, they incentivize them. In China, we call it 购物导购. 导购 means you got the shoppers to buy. So it is to that kind of meticulous detail, because of the fact that we want to be completely aligned with the success of our tenants, right? Because of the sales model, the more sales they chalk up, the more commission we get as a percentage, and also from an absolute number is higher. It is a win-win for all. And also because of this, the tenants don't have the burden of the high fixed operating cost structure. They are more prepared to go all the way to boost the sales by, working in close partnership with the landlord.
Okay, so again, my jaw is on the floor here. So you also train the salespeople of your tenants?
Yes, we do. This is very unique, right? But I think this is really one of the key differentiator of our group, and this is really our competitive advantage.
I'm so glad you guys are on tonight. So I've been learning a lot more about Sasseur REIT, and obviously this is something that I don't think can ever be done in Singapore. But,
yeah, they have honed this for over 14, 15 years. In fact, my chairman had in retail business for more than 30 years. He really understood the consumer psyche. Yeah.
Yeah, and I guess it can only be adopted in a country like China because it's entrepreneurial, and millions of people are moving into the middle class. They're go-getters, so on and so forth. not like the laid back Singaporean nowadays. Yeah. Okay. All right. So in the interest of time, just going to quickly go through some of these questions. Let me see. Okay. So there was a question in the pre-submitted bunch about the trading share price. Related to that is a new one that came in. Why is Sasseur's stock price trading about 15% below NAV?
Yeah. Okay, I think if you had seen Geoff Howie's number, right? In fact, we are 15% to NAV, but if you look at the rest of our peers, CapitaLand is trading at 24% discount to NAV, higher than us. EC World is trading at 30-something% to NAV. Probably today worse, I think they dropped more. And BHG as well. So I think when you look at the REIT's performance, I think you look at both from a stable distributions, trading yield and price to book. To look at just one dimension probably is insufficient. In fact, I have some slides I don't mind just sharing with you. We have prepared some data points to share with the unit holders. Chusi, if you can share. Okay, I like to sort of take everyone back. Because I think you cannot just look at one year and then say, oh, why is it our share price has dropped? All right. So if you look at historically, of course, 2020, everybody suffered with that. But you can see over the years, actually, we have outperformed the peers on a relative basis. Okay, I think it shows the resilience we have. Now, in 2021, why is it overall second half was worse? If you remember, China started the whole technology and property sector clamp down, in full force in August, you remember, 2021. That definitely has dampened the overall market sentiment. And unfortunately, when you talk about property sector, anything which is brick and mortar is considered property. And we also were sort of like hit due to the sentiments in the market. And capital markets, stock markets always a bit ahead of everything else. So they tend to react first. Right, but you can see actually in 2022, our share price has been relatively quite strong. I would say it's quite firm, despite the fact that we are still in a pandemic environment. And later, maybe one more slide to show. Yeah, so this is actually the share price performance even against the Singapore retail REITs. Okay, I think this is quite interesting. We also try to benchmark with the rest of the peers. I think clearly, we have also been very resilient in terms of our relative performance. And the last slide, just very quickly, very interesting points. Okay, couple of things here. When I look at this data point, I like to highlight, if you look at the DPU, we are the only one consistently positive. 2019, 2020, 2021. In fact, 2021, we even started 10% retention. If not, this would have been a double-digit growth relative to 2020. But if you look at the comparables like China Land Capital Trust, negative DPU in 2020, and some of them, they have not even recovered back to 2019 level, but we have already surpassed 2019 DPU by 8.7%. And if you look at distribution yield, actually, we have been very stable, right? Trading in the range of, say, between, the mid-7 to mid-8 level, but you can see the volatility of the other REITs. That is a function of their DPU profile. So I think hopefully this will give a bit more sort of objective perspective to our share price performance.
Well, certainly, I guess a lot of investors in Singapore, at least, do view REITs as dividend plays, and more the stable part of their stock portfolio compared to Bitcoin and Tesla. So, I mean, having consistency in the performance is always very welcome. So, thank you very much for that. I think that's our performance is very welcome. I think in the interest of time, maybe I'll just pick one more question, maybe related to the occupancy. So, 3 of the malls have occupancy above 90%. One of the malls 85%, which was an improvement over 80% previously. So is the management confident of increasing the occupancy closer to 90%? And I'll just add on my bit here. And based on your business model that you talked about just now, there's always going to be some churn, right? Because some of the retailers that cannot outperform, you're gonna get them out, and you're gonna bring some people in. So how does that factor into the lower than,
Okay, I think the more in the subject matter is Bishan. Okay, just to put in context, actually Bishan is the smallest outlet we have in the portfolio, but nonetheless, we still care about the smallest outlet because, you know, everything counts towards the total sum. So I'll let my colleague give you a bit of a story behind this occupancy trends.
Okay, so for Bishan Mall, I think the question is asking whether are we confident that our occupancy will edge towards 90%. At this moment in time, and based on our current figures, we are confident that it will continue to improve. So the reason is that maybe I just want to recap why we are able to improve, because we have repositioned, remixed, and enhanced the mall. The mall actually has 21 independent blocks because it was built on a hillside. So what we have done was that we mixed and then we connected the 21 blocks so that the shoppers flow will be smooth. For example, just now during my presentation, I said that we converted one of the driveway into a pedestrian driveway and converted 2 buildings into a sports team zone. As you are well aware, China is promoting sports, and that's why sports and its equipment and accessories are in high demand. That's why there's a Chinese saying, Chinese way of reconstitution is called 一拖二, meaning that we will have one brand to occupy 2 floors. So if you look at the pictures there, Fila has 2 stories, Nike has 2 stories, Li Ning also has 2 stories. And then this gives a very spatial view and it will draw crowds. When it draws crowds, it will spill over to the other parts of the mall. And this will bring in new tenants. So that's why it's a factor that encompasses many factors, and the occupancy will go up. So I hope that will answer the question. Thanks.
Well, and I think it's pretty innovative because I think the only big shopping center in Singapore that has got an E2 is Marina Bay Sands. We have got the Louis Vuitton. Yeah. Yeah, you know, when you go to Ngee City, you don't really have that. So it's quite innovative, and yeah, it definitely does improve foot traffic. Yeah. So ladies and gentlemen, that is all the time that we have for. We are 17 minutes over time. So for those of you who are scheduled to watch your favorite K-drama at 8 o'clock, apologies, but I want to thank Cecilia Jianfang as well as Xing Yuan for joining us today. This has been very educational, illuminating for myself, I can say, because didn't really understand the innovations that Sasseur REIT has put in, and I'm still trying to pick up my jaw from the floor. Like, you guys actually train the tenants, salespeople? Goodness. All right. All right. So thank you very much for joining us this evening.
Thank you, panelists, for the insightful sharing tonight. Yeah, thanks for staying on for a slightly overrun. In case you have missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. So Corporate Connect is a bi-monthly webinar, and do visit our website to get updates on the upcoming investor education program. And initially, the upcoming Corporate Connect will be featuring United Hampshire US REITs on the 28th of June. Thank you and have a good evening.
Thank you very much.